You don't notice it the first year. Nobody does, because the most powerful force in personal finance doesn't look like a force at all. It looks like a rounding error, a tiny percentage, a number so small most people ignore it. And that's why 97% of people never escape the financial gravity holding them down. The truth is simple and brutal. Your financial future is determined by a single number, your personal 3%, not your income, not your job title, not your investment picks, your 3%, the percentage that quietly separates those who build wealth from those who just talk about it. For decades, financial institutions have used this law to predict who climbs and who collapses. They won't say it publicly. It's too revealing, too humiliating for the masses, but every internal model, every lifetime value prediction, every long-term risk assessment is built on the same formula. Will you consistently move 3% of your resources, time, or capital in the right direction every single month? Banks know the answer before you do. Your spending pattern, your credit behaviors, your deposits, everything gives them a signal. They can tell if you're going to be high net worth potential or lifetime debt asset before you've even had your morning coffee. Because the law of 3% is not a motivational idea. It's a measurement of human behavior. Most people burn their energies chasing dramatic changes. New job, new business, new investment. But these are emotional explosions. They rarely last. What compounds is what you do when you're tired, bored, irritated, or distracted. And the data shows people who hit long-term wealth trajectories do one thing differently. They improve or invest 3% more than the month before. That's it. 3% more saved, 3% more invested, 3% more skills upgraded, 3% more income captured or inefficiency removed, a microscopic shift that compounds into a mathematical avalanche. This is the part nobody likes hearing because it sounds too small to matter. But here's the cruel irony. Small is the only thing that scales. Every major fortune you admire was built on the same principle. Not a leap, not a miracle. A methodical, disciplined, almost boring series of 3% improvement stacked over years. But while wealthy individuals apply the law of 3% deliberately, most people apply it accidentally. In the opposite direction, 3% more on lifestyle inflation, 3% more on subscriptions they forgot to cancel, 3% more on a car payment that grows into a financial parasite, 3% more drift instead of direction. And that creates the exact same compounding curve, but downward. The moment you understand this, a quiet shift happens. Your future becomes predictable, not in a mystical way, in a mathematical way. Because the law of 3% is the only financial behavior that exposes where you'll be in 5, 10, or 20 years. And now that you know it, the question becomes painfully simple. Which direction is your 3% moving? The moment when the 3% signal first appears, quiet, harmless, and completely ignored by 99% of people. There's a strange pattern that shows up long before wealth becomes visible. A micro movement inside your financial life so small that most people step over it without noticing. But the people who eventually escape the gravitational pull of paycheck to paycheck life, they always detect it. And once they do, nothing looks the same again. It usually begins with a review, a normal evening, a bank app open on your phone, a quiet sense that something isn't adding up. You scroll through transactions, not looking for anything specific, just checking. But tonight, one number catches your eye. The amount you kept, not earned, kept. Maybe it's $40 left at the end of the month. Maybe it's 112s. Maybe it's barely enough to buy groceries, but it's positive. And that's when the system reveals its first whisper. Your real financial future is not determined by what you make, but by the percentage you keep. And that percentage, whether you know it or not, is orbiting around a single threshold, 3%. This is where the earliest observers emerge, junior analysts, budget researchers, economists buried in spreadsheets, ordinary workers who decide to track their money for the first time. They don't see wealth yet, they see drift, a tiny positive tilt in the math, and the deeper they look, the more unsettling the data becomes. Across countries, decades, salary levels, crashes, recoveries, and inflation cycles, the same anomaly returns. Whenever someone consistently keeps 3% of their income, even by accident, the long-term projection line shifts from flat to rising. It is too small to celebrate, too quiet to feel meaningful. But mathematically, it is enough to tilt the entire trajectory of a life. You compare this to historical data. In 1974, households keeping even 3% outran inflation over full cycles. In 2001, the dot-com crash didn't erase savers above the 3% line. During 2008, the families whose savings rate never dropped below 3% were the ones who recovered first. And in 2020, when the world froze, 3% was the dividing line between panic within weeks and survival for months. It's an eerie pattern because it shouldn't be possible. It's too small, too simple, too unglamorous. And yet, the compounding effect doesn't care about feelings, headlines, or ambition. It cares about mathematics. It cares about thresholds. And the 3% threshold behaves like a financial escape velocity, the bare minimum force required to break free of orbit. You look again at your own number. Maybe it's not 3%. Maybe it's lower. Maybe it's higher, but now you can't unsee it. Something inside you tightens, the awareness that wealth is not mystical or mysterious. It's mechanical, algorithmic, predictable, and the 3% line is the first crack in the illusion that wealth is for other people. The moment you detect it, truly detect it, the game changes, because now you're not guessing. You're measuring. You haven't reached financial momentum. You're nowhere near freedom, but you're no longer blind. And that makes you more dangerous to the system than you've ever been. What makes the 3% number so powerful isn't its simplicity, it's its inevitability. Once your financial life crosses this threshold, the math begins behaving differently. It stops relying on luck, timing, or perfect decisions, and starts relying on something far more predictable. Long-term compounding supported by a widening gap between income and lifestyle. Most people think wealth comes from earning more. The truth is far more mechanical. Wealth comes from expanding the space between what you earn and what you keep. And the moment you consistently save and invest at least 3% of your income, that space begins to operate like a second engine beneath your financial life. The best way to understand the 3% law is to zoom into what actually happens inside your numbers year after year. Let's say your income is completely average, nothing dramatic. The majority of people at this level save a symbolic amount when they feel motivated, skip months when life gets noisy, and never build enough momentum to break out of the psychological gravity that keeps them paycheck dependent. Their savings rate fluctuates between 0% and 1%. Mathematically, this produces no compounding base. Emotionally, it produces frustration. But once you cross the 3% threshold consistently, the shape of your long-term projection changes. 3% may sound small, but over a decade it becomes transformational. 3% of an average income invested automatically becomes thousands of dollars per year, working silently in the background. And once the base grows large enough, the returns begin overtaking the deposits. That is when the law becomes visible. Your trajectory bends upward with a force that feels disproportionate to the amount of effort you put in. This is the part most people misunderstand. They assume that big wealth requires big savings, but the 3% law shows the opposite. Big wealth requires consistency, not extremity. Saving 3% every year for 30 years beats saving 10% randomly for 5, because compounding doesn't reward intensity. It rewards duration. It rewards the investor who stays in the game long enough for mathematics to overpower mood. The 3% law also exposes a deeper truth. Wealth is not about income, it's about behavior. Two people earning the same salary can live two completely different financial lives simply based on whether they cross this threshold. One becomes stuck, The other becomes upwardly mobile. 3% is the dividing line between the two trajectories. What's even more interesting is how the 3% law scales. As your income grows, your lifestyle naturally tries to expand with it. Most people follow that instinct. Their expenses inflate in perfect sync with their raises, so their net worth curve stays flat. But those who follow the 3% law apply the rule mechanically. Every time income grows, they maintain or increase their savings percentage. This creates a widening margin, the exact condition that allows net worth to accelerate. The psychology here changes as well. Once your savings rate becomes predictable, you stop asking emotional questions like, "Do I feel like saving this month?" and start asking structural questions like, "How can I increase my margin over time?" That shift from emotion to structure is what turns the 3% law from a guideline into a long-term wealth engine. Over a lifetime, this percentage becomes the most accurate predictor of your financial destiny, more accurate than your job title, income level, market timing, or investment picks, because at 3%, momentum begins. At 5%, acceleration begins. At 10%, independence begins. The law is simple, but its implications are enormous. You don't need to be extraordinary to build wealth. You just need to keep 3% of your income working for you every year without interruption. There is a moment in every long-term investor's life when the 3% rule stops being a tactic and becomes a worldview. You don't notice it at first. You just start thinking differently, reacting differently, interpreting money differently. But if you look closely, this phase is the clearest signal that you've crossed into the mindset the wealthy have operated from for decades. It's the point where the 3% law stops being a number and becomes the mental anchor for every financial decision you make. This psychological shift begins when you realize that 3% is not about growth, it's about predictability. Wealthy people don't obsess over how fast something grows. They obsess over how reliably it grows. They don't ask, "How much can I make this month?" They ask, "What does this look like in 10 years if it compounds at 3%?" And the second you start thinking in those terms, you distance yourself from the 90% who constantly sabotage their own progress by chasing speed instead of direction. When the 3% mindset locks in, your emotional framework changes. You stop expecting dramatic jumps in your net worth. You stop chasing investments that promise unrealistic returns. You stop reacting to daily fluctuations in the market. Your focus shifts from performance to consistency, and that's exactly when your portfolio starts stabilizing and accelerating simultaneously. Most people never reach this stage because they never make peace with slow growth. They confuse slow with weak, not realizing the strongest financial systems in history were built on modest, predictable compounding. Pension funds, sovereign wealth funds, endowments, none of them chase 20% returns. They chase stable 3 to 6% compounding across decades because they understand the truth. The longer your timeline, the more unstoppable small percentages become. When the 3% rule becomes part of your thinking, you begin to recognize a deeper pattern. Money isn't emotional, but people are. And emotional people lose to predictable systems every time. You start seeing how volatility punishes the reactive and rewards the patient. You notice how your portfolio quietly recovers, expands, and strengthens after every downturn, simply because you stayed invested. This is also the stage where risk transforms from something you fear into something you measure. You stop asking, "Will this crash?" You start asking, "What does a crash change over 15 years?" And the answer, historically, has been not much. Because once you're operating inside the 3% law, crashes become temporary discounts, not permanent threats. You stop treating volatility like danger and start treating it like background noise. Your emotions detach from your portfolio, and that detachment is what the wealthy have mastered better than anyone else. Another crucial shift emerges. Your sense of financial time expands. You're no longer thinking in months. You're not even thinking in years. You're thinking in arcs, in decades, in cycles. You understand that 3% isn't about today, it's about inevitability. It's about what happens when time is no longer your enemy, but your primary contributor. Most people never get here because they stay addicted to the illusion of big numbers. They want 2x returns in months instead of 3% returns in a year. They want excitement instead of progress. And excitement destroys more wealth than recessions ever have. But when you cross into the 3% mindset, the noise fades, the fear fades, the urgency fades, and what replaces it is something rare: financial stability that compounds invisibly until it becomes unmistakable. In the next part, we'll break down the final stage of the 3% law, the phase where this quiet, unremarkable percentage becomes the single most powerful force determining your future wealth, freedom, and long-term financial identity. There comes a point in every long-term investor's life where the financial law of 3% stops being a theory and becomes a personal truth. It doesn't happen when you make more money. It doesn't happen when you cross a milestone. It happens the moment you realize that 3% is not a number. It is a compass. It is the lens through which every financial decision suddenly makes sense. When the law fully activates, the future stops feeling random. You stop guessing where you'll be in 10 years. You stop relying on motivation. You stop hoping everything will just work out. The 3% framework gives you something most people never have: a predictable trajectory. Not a perfect one, not a guaranteed one, but a stable, repeatable one. The kind that compounds quietly, invisibly, relentlessly. The first major shift is psychological. You start thinking about your money the way engineers think about structures, through predictable stress points, load distribution, and long-term endurance. You begin to see that if you keep expenses growing slower than your income by even a small margin, your financial life inevitably separates from the average person's. You're no longer competing in the same system. You've changed the rules entirely. Most people inflate their lifestyle with every raise. You don't. Most people treat income as something to spend. You treat it as something to deploy. Most people let their emotions dictate their financial path. You let ratio do the thinking. And while they oscillate between progress and setbacks, your curve steadily rises, almost indifferent to noise. The second shift is mathematical. Once you internalize the law, you understand something powerful. You don't need dramatic returns to build dramatic results. You don't need to predict markets, chase trends, or gamble on timing. You only need to stay above the 3% threshold consistently. That's it. That is the entire blueprint. You realize that a lifetime of staying 3% ahead in savings, in spending control, in net worth growth outperforms almost every get-rich-fast strategy on the planet. Because while others burn out, restart, and collapse under volatility, your trajectory compounds without interruption. The third shift is behavioral. You begin managing your life around long-term stability instead of short-term excitement. You stop comparing yourself to anyone. You stop reacting to every headline. You stop searching for the next big thing. You realize that predictability itself is the ultimate financial superpower. And the law of 3% is what creates that predictability. It's here in this final stage that your future begins to feel like something you can actually shape. You know how much you can save. You know how much you can grow. You know how your net worth will behave. And because you know, you act differently. You start navigating opportunities with confidence. You start recognizing risks more clearly. You start seeing your life as a series of deliberate choices rather than reactive jumps. This is the moment wealthy people talk about. The moment when money stops being a fear and starts being a tool. When you're no longer climbing blindly. When the map finally aligns with the terrain. The financial law of 3% doesn't make you rich overnight. It makes you unstoppable over time. And for the first time in your life, the future feels less like a gamble and more like a direction.